What's up, Outliers? How is everybody doing? We had a kind of a fun start to the week. Markets were up a little bit. They were actually showing some strength. And then, as per usual, there's a curveball. And the curveball wasn't really that much of a curveball if we think about it. The curveball primarily was Trump doing what he said he was going to do. Kind of reminds me of Big Daddy J Powell when everybody's just like, yo, I wonder when rates are going to lower. And Big Daddy J Powell keeps saying, like, nah, fam, we're not ready yet. And every time he does that, the market's like, oh my God, I can't believe it didn't lower rates. Never saw this coming. The comedy of the market reaction to stuff literally will never, it just will never cease to entertain me. It's so awesome. I love it. It is absolutely hilarious. So we are going to talk a little bit about the market today. I want to talk briefly about February performance, like just provide a super quick overview just because I like to let you all know where I'm at, where things sit. I already talked to the Discord briefly about this, so we'll buzz through it super fast, but just in case people choose not to be in the Discord, which is totally cool. It's free to join, but totally cool if you don't want to be in there. Discord is kind of a little like overwhelming if you're not familiar with it. I remember I absolutely would have never been on Discord if it wasn't for one of my early viewers who was on Discord, who literally built the skeleton that the Discord community is today, because I also would look at it and be like, yo, this is kind of heavy, guys. I'm not all about this. But we'll talk a little bit about that. And then I want to talk to you a little bit about some of the adjustments in the covered strangle portfolio, because there are a handful of things sliding around today. And then if we have time towards the end of the video, we'll take a look at hopefully Q&A if there's anything you want to take a look at, anything like that. But let's get right into it. So for February performance, if I grab my little screenshot here, this is a summary effectively of where things sit. It's just a screenshot of how I tabulate kind of the export version in Excel. To be honest, the versions that I look at are really, I mean, it's just numbers. It's nothing visually appealing at all. And it kind of takes a minute to get used to what you're looking at. So I made this for you guys a while ago just so that you can get a sense of where most of the portfolio performance is coming from via the strategies. So as of the end of last month, towards the end of last month, I gave back a lot of the overall gains, specifically from the core allocation. And the core allocation is about unchanged month over month. And a lot of that has to do with the S&P performance that we saw. And the S&P 500 over last month, let me see right now, what did it do? The S&P 500 last month was what, down 1.4%? Does that sound about right to you guys? I think that's about right. And for me on the month, it was like a 10.4% month. Now, a lot of the performance, as you can tell, this graph looks a lot different. And it's because the speculative allocation is picking up a lot of slack. And this is exactly how I trade through market conditions like this. Now, the only reason why the core allocation even walked out of last month unscathed is because of the scaling protocols that I follow, where if we take a look at something like TQQQs, which is one of the tickers that's in the covered strangle portfolio, you can see essentially what it did in February. Let's see where it opened. February was here, February 3rd. So this is where it opened, and then it would have closed here. So TQQQs also had a fair down month, right? So it opened at 78.53, and then it closed at 74.92. And a big reason why, when we have something like TQQQs down, that my covered strangle tends to still be up, is because I scale out. I do not allow the winning position to roll over into a large losing position. So what ended up happening was I had TQQQ position built from, when did I first start buying into it? I'll tell you right now. Back in 15 October is when the study started. So that was back when TQQQs was like 72.69. And I obviously, that's not where the total basis was. That's where the first purchase for this exercise came from, and then scaled into it throughout the rest of the time so far. So what I end up doing is over this time frame, sometimes I'm buying it cheap, sometimes I'm buying it expensive, but as long as it's drifting up, I don't care. But as we go through cycles like this, where we hit highs of like 91, and then we start rolling over and we end up down in the low 70s, I very infrequently will hold the whole position through this. I will start paring some of it down. And that's exactly what I've done. Now, comically enough, I started buying back into it yesterday here, and then I bought more today. So I am building a smaller position to kick off and get at least a little bit of equity exposure. Target right now is something around 20% of the allocation. But that's the main reason why you'll see the performance for the covered strangle is still solid. Now, again, this is year to date. This is not for the month. This is year to date. So other key notes here, the ratio diagonals definitely have been a primary return source. And then also stepping up the involvement with put diagonals, or really just long puts. I bucket those into the same thing. Same thing for ratio call diagonals. Sometimes it's just long calls. The reason why I do that is anything that I trade directionally via long calls can easily be turned into a ratio diagonal, or vice versa. It can start as a ratio diagonal and be pared down. They're interchangeable in my mind and how I apply them. And then also a step up in volatility plays. The volatility plays have actually been pretty important. And a big reason why the volatility plays have been so important is because without good volatility exposure right now, the return profile actually becomes a little more challenging to totally produce overall. So that's where things generally sit. And then one other admin note, let me see, what is that? Well, yeah, that all looks good. Okay. I think that's it from like a performance perspective. If you guys have any questions, obviously feel free to let me know. But the main stuff was, I was looking through my notes, and trading activity did tick up a little bit. So total number of transactions did grow a little bit. Doesn't really surprise me, to be honest with you, just because of the earnings season and stuff like that. And then I'm also trading more index vol. But I mean, it's just kind of business as usual. As you could tell, it's not like some crazy cool return, right? It's very, very inside, but I pride myself in the consistency of returns. And that's really what will probably take me through the rest of the year, because honestly, to be up 20% within the first 2 months, like that's pretty strong. And I think a big reason for that really came from this last earnings cycle. And then this pop in volatility from the broader market conditions have led to volatility trading really recapturing a pretty meaningful part of the percent return of the portfolio in a relatively short-term time frame. Because normally it takes a little longer for me to see the returns to pipe up like they did. So that's really where things sit as of today. I know not really anything too crazy or fun, but you know, gets the job done, I suppose. Kind of how I look at it, at least. So yeah, if you guys have any follow-on questions, feel free to let me know. And then let me take a look at the last thing. Oh yeah, I realized one of these is mislabeled. This one says speculative coverage strangle, and that shouldn't be that. That should be speculative 0 DTE. And it's really speculative SPX more than anything, because I've opened up that bucket a little bit. It's not just, it's definitely not just 0 DTEs anymore. Actually, most of what I'm trading right now for index vol is not 0 DTEs. It still is 0 DTEs most days, but it's mostly a mix of things. So yeah. I think I think that about sums us up. Anything else that you guys want to hit on that? Tommy says, are you still positive deltas? Sort of. I mean, net long, but I have a whole lot of short satellite positions for sure. So yeah, it's kind of a little bit of a mix there, I would say. Yeah. So general, yes, but not total. Like, it's not just sitting at long deltas. It's definitely a pretty healthy mix of things as things are right now. And really the big reason for that is because we can see a lot of opportunity right now, as far as I'm concerned, at least, from trading things through these broad directional shifts. Because here's a common thing that'll happen during periods like this. We will see a lot of opportunities emerge that do not remain super strong. And a big reason for that is because the markets will have this like really, really ugly kind of crash down phase to it, but then they typically will recapture. So when that happens, we have to obviously wait and see when that eventually comes to fruition. But I think while it's happening, like these kinds of moves, you can make a lot of money on these kinds of moves, which is exactly, you know, the idea for trading things. When I'm trading stuff from a short-term trading perspective, and I think I've told you guys this before, because at least to me, it's a fairly important note, is that when things crash down like this, I am very, very interested in trying to participate as much as I possibly can before things slow down too much. And they will almost always slow down. Now, how quick that comes, today we actually got a little bit of a continuation note, which, I mean, I honestly think is fairly fortunate. And a big reason for that, obviously, is from the Trump tariffs, which actually there was a clip that I wanted to show you guys that reminds me. Let me find it really fast. What screen am I on? I want to play this clip for you. It was on the Trump tariffs. Is this it? This one. So I got to turn the volume off, and then I'll turn closed captions on. And then this, it's only like a couple minutes, so we'll watch this together real fast. Or not. Why did this completely freeze? There it goes. Keeps freezing. I don't know why. Bro, what the hell? Now my mouse is gone. All right, this thing is struggling hard. So the main thing I thought that was really interesting about this was a lot of the impression that it was almost like he's viewing the tariffs as kind of like a punitive function. And then it rotates into trying to complete the domestication of work. I don't know. I just thought it was really interesting. And the reason why I mentioned that point is because obviously the market also thought that this is a little strange, because it seemed like with the tariffs being delayed a month, it seemed like there was going to be a path where the tariffs might be avoided. But then now it seems like that's not so much the case. So very, very interesting behavior across the board. But I mean, it is what it is. Now, the interesting part about tariffs is that they do open the door to opportunities, and trade opportunities continue to be all over the place, from trying to trade index movements to finding individual names that are exhibiting strength, which there are still a lot, to trading earnings. There's really so much to be done right now. Of note, however, if we take a look at NVIDIA, that's pretty ugly. Like, this does not necessarily look really solid for NVIDIA. And this is now starting to challenge even these lows. So if this continues to post lows in this way, that's fairly catastrophic for what NVIDIA has been able to accomplish over the last several months. But if you take a look, we've essentially undone 6 months, right? Like, this is where we opened 6 months ago and we just closed below it. So NVIDIA is very, very much trending sideways here. On a longer term time frame, we can still obviously see tons of upside and lots of growth. But even if we go back almost a year ago, we've given up most of what we've created essentially since the end of April. So the general movement that we're seeing in tech is going to continue to drive the short-term sentiment. Now, the other cool part about this, though, is that I still overwhelmingly think the market is very well positioned, especially with AI. So that's why even when the market does start to look as ugly as it does right now, I just see such a massive catalyst sitting in front of us through something like AI, that I think all of this will effectively be not like a minor blip in the radar. That's kind of selling it short, to be honest, but this doesn't make me nervous as, okay, we might be entering like a significant bear market or something like that, although we are getting very, very close and hovering right around a correction. So that's probably not that far off the table. And a lot of that will come through simply because of the tariff stuff. I don't necessarily think it's a change in underlying business conditions outside of that. So there's a lot of those external factors right now. So very interesting market behavior. Now, I want to run a couple scans really fast. And then if you guys have anything you want to look at, now's a perfect time to start throwing it in because I got like another 10 minutes or so. And then I got to bounce. So let's take a look at a few scans together because there are still things showing fairly persistent strength that are worth at least talking about. Let's do the gap up on the day. And then I need to change this. Yo, what in the world? I really got to figure out why something has changed with OBS that it's like completely locking up my browser for some reason. And it just normally does not do that. But OBS was just updated. Every once in a while it does that. It gets real weird for a while. All right, let's get total OI. We want at least 500. Last price at least $2. I realize I just duplicated open interest because I'm a silly goose. All right, let's see. So these are things that are gapping up on the day. And you can see that there are some, oh, we looked at this one a few times now. I've already flagged this one to you guys. This has been flying off the damn shelf. Even today, it had a big nasty red day, but it's still gapped up, bro. So there's still a lot of strength. It's just pocketed. It's not as widespread as I think people might be used to seeing. And the fact that there are still pockets of strength, it still shows us that this is not like a total market rollover. This is obviously a broad market pullback, but how far it shapes and materializes, I think, will have a lot to do with a couple things. One of them absolutely will be the war in Ukraine and Russia, how that comes to pass and how impactful that can be. And that is actually something to be really thoughtful about, by the way, because that meeting between Zelensky and Trump was very interesting. It's really not the way I expected that to go. I don't think it's the way most people expected it to go. But it didn't surprise me that it didn't go that well. And for those that don't know, the President Zelensky, he did a podcast with Lex Friedman that was pretty good. Lex Friedman, I have a lot of respect for him. His podcast can be a little difficult to listen to. Maybe it's just because I'm not smart enough, or I just think he's like very monotone. So anyways, my personal opinion is that nobody asked for aside. The reason why I offer that personal opinion here, by the way, is because if you feel that same way, it's still worth listening to. And anyways, one of the things that came out of that podcast listening with Zelensky and Lex Friedman was that there is a lot of pent up aggression and issue, rightfully so, with Ukraine and Russia. The problem with that, though, is that if the way to close this war out is through an agreement, it's very difficult to do that if one side is really disenfranchised with the other side. That becomes very, very difficult to manage. And it's actually one of the things that Lex Friedman pointed out while on the podcast with Zelensky. And I can totally respect and understand Zelensky's perspective, but he's in a very precarious spot because Ukraine without external support is in a real precarious place. So the reason why I'm getting into all that, one, obviously it's a personal interest of mine, just global security and stuff from a military mindset. But beyond that, If that war starts to meaningfully escalate, which is not off the table, I still generally view that as less likely than more likely, but it's not off the table. If that does escalate, that's the kind of condition that can send the market reeling downside. And that's something I'm paying very close attention to, because that is the exact kind of condition where my entire investment strategy would literally flip overnight if that happens. So I'm waiting to see the way it goes. Again, the way to think about markets as a trader is that we never know what's going to happen, but we have to have an idea of what we would do in different scenarios based on the broader context of what the world is doing. And so that we're not caught off guard, because I can tell you exactly what would happen to the majority of retail traders who are kind of passively involved. If that war escalated, they do not have a playbook ready on what they would do. And it would take them a couple days to get their feet under them to figure out what to do with the portfolio as it sits, to try to find new opportunities. And by that point, you are late to the dance. So anyways, all of that is an encouragement for you to prepare yourself. And again, I'm not preparing myself for something that I view as super high probability, but it is something I view as higher severity, which means it's something that deserves my respect. Now, that stuff aside, that's one thing that can really change this broader market picture. The other thing, the good part with the tariffs, is that I think a lot of what we're seeing in the short term is absolutely sentiment driven, meaning most large banks have already priced in most of this, meaning the tariffs, because these aren't things that popped up overnight. These are things that have been on the docket for the last month. And then if you paid attention during Trump's cabinet meeting, he talked a little bit about these, and there was no talk about belaying them again, kicking them down the line. So I think most institutions had a sense of what's going on. And guess what? As per usual, the fucking options market tells you what's going on. And I didn't post about this because I was playing it myself. And we have seen rapid build out in VIX options over the last 4 days. And there's a couple really large trades that have come in, and I'll show you. As per usual, the market knows what's up. So if we take a look at VIX, and if we take a look at let's just clear out, let's take a look at very, very clear pricing. And let's take a look first at the last 7 days. Take a look at the total premium that you're seeing across these long calls. And most importantly, pay attention to what contract, where they are. And then if you take a look for a prior reference range, if my computer would not freeze, we go to another reference range just for an example. We'll go not to November, we'll just go like somewhere in here. Notice the difference. I just picked a random time. So what I'm showing you is that if you develop a relationship with things, especially things like VIX, it is wildly telling. And you can see the build out occur near real time. You take a look at the total amount of premiums that have been purchased for relatively short dated calls. You have the majority of these are 43 days, a couple 14s, but the overwhelming majority of these $1 million plus trades are 43 days out. That does not happen normally. And again, I just gave you a prior reference range just to give you something to compare it against. And again, it was a random range. This range I'm cherry picking because I can clearly tell some shit's going on. And this build out started again, like 4 or 5 days ago. You see it start on the 25th, 27th, and you can see it repeatedly getting hit. So the market provides, per usual, So the trade here is really interesting because VIX obviously looks strong, but if you take a look at UVXY, this is where my trade was. And it is for the leverage. The leverage. We come in here for leverage. It's always likely to fall apart. And the cool part about trading a leveraged position is there's a higher probability of losing your trade, but you can lose less money because you don't have to put on as big of a position to get the same exposure. That's why I like something like UVXY for this exact kind of idea, which is a very short-term idea. And then the fun part about trading volatility is, guess what? I'm going to play it to the downside as well. Typically not as profitable, to be completely honest with you. Playing VIX spikes to the upside is always dangerous because if it takes too long, the market essentially will penalize you through theta decay. But trying to play the reversion is more challenging because everybody and their mother we know it's going to revert. Whereas when the spike is going to happen, we don't know when it's going to happen. So it's a little more easy if you get your move to make money to the upside. To the downside, it's a higher probability of making the money, but you typically make less money. So that's the roadmap. Pretty easy stuff as far as I'm concerned. Now let's go back to the scan really quick. And I realize it's already 5:30, so I got to hop off in a minute. But let me see what you guys have if there's anything that we want to hit. Zach says, today was rough. Did not see the sell-off coming. So much for me thinking we had bottomed. Too much thinking with my heart, probably. Yeah, well, and I mean, the other thing is like, you just never know, right? Like going into the market with an expectation of, oh, like, did we bottom here? It's okay, but it's also like, what does that do for us? It's the role of a trader is always Bayesian analysis. That means we come up with the best possible mental model that we can until new information emerges, and then we update the mental model. So to your point, I think just about all of us thought a similar thing, to be completely honest, right? Like if we take a look at what the market did on Friday, if you look across everything here on Friday, just about everything benefited. So that is the start of something. Now, I think it's way too premature to think whether or not we bottomed or not there, to be honest, just because it's one day. You really can't come up with a conclusion in one day. But with the start that we had to the market today, it looked probable. But then the tariffs came. So when we have new information injects like that, it's always going to be real challenging. And that's why it's so important to remain as flexible as humanly possible as a trader. It's literally our job. We have to be able to pivot rapidly because the markets move around a lot. So yeah, I think to your broader point though, avoid at all costs making trading decisions with emotions or, you know, obviously your term there was the heart. We want to avoid that. We want to use solid analysis that's based on data. And you can get a lot of really great data points from the market. I mean, take a look at this. Healthcare had a great day today. Utilities, great day today. Real estate ticking up today. Staples ticking up today. So again, like the market as an entire entity is not dying off right now, but tech is. And as we know, tech, even with the S&P 500, it's over 30% of the S&P 500. It's huge. So the S&P 500 is going to move by the way of tech. A show. Let's see. Zach says, what would your strategy be if that happens? Put options. I think you're referring to when I was talking about if the war kicks up. It depends entirely on the context. But essentially what would end up happening in broad muscle movements would be coverage strangles would get pared down to minimal viable products. So what that means is for the coverage strangle, I very rarely come flat to cash, but I get very close to cash. Now, in something like TQQs, I do go flat to cash because it's 3 times levered and it's more of a speculative hybrid coverage triangle. I still consider it core. It's all bucketed together, but it is speculative in nature because it's 3 times leverage. So that's one of the first playbook items. The other thing is things that benefit from war obviously start to get put on with leverage. So, for example, the Palantir position I have on, I would expect that to do well. I would expect the other defense contractors to do really well. I would also expect fixed income to do better, debt instruments. I would expect to see pair relationships get distorted, that I would then play the normalization of those. And then for broad directional movements, it's straight to futures. Yeah, anything like that, straight to futures. Alberto says, can you look at AVGO? It has earnings this week and it looks like it'll do well, but I think the movement will be drowned out by the broader market movements we're seeing, like NVIDIA. Well, NVIDIA's earnings is a little bit of a different story, to be honest, if you're paralleling it to that. Because a trail down into their earnings, I think, does them a favor. It makes it easier to see some sort of up move. But let's take a look. The 6th. Let's get rid of this. So the options chain looks generally built to the call side. Let's see. Yeah, 58 against 42, so not massive. I mean, it's for me to, it's hard to say. I think it's real hard to say. I don't see a clear positioning with respect to the options chain, though. We can look across and see if anybody has been building into anything in there, and then what direction they might be building into. Just making sure all the filters are correct. Let's see. $210 put, $280 put. I mean, it looks like a lot of put activity to be on. Yeah, it looks like a lot of put activity, but this is really normal. The reason why you'll see this is because people will hedge bigger stocks like this into the earnings release. Let's take a look. Let's take a look over the last 3 days. Yeah, I mean, it's mostly put premium that's coming in super heavy. Last 7 days. Yeah, I mean, it's mostly put premium that I see. And this froze again. Yeah, and then, yeah, you can see the volume stacking over the last. I don't need 15 minutes. That's so excessive. Honestly, if I could just look at this in terms of a day, that would be fine. Yeah, I mean, I don't personally have some sort of baked opinion on how it'll do during earnings. I don't see anything super conclusive, though. Just eyeballing things. Had a really good last earnings. Poor earnings, good earnings, poor earnings, poor earnings, poor earnings, poor earnings, good earnings. Kind of like a mixed bag. But it does look like its recent earnings trend looks a little bit stronger. So yeah, I don't really think I don't really think anything strong directional wise, for me at least, just because of the options position. That doesn't mean that it can't move really strong. It looks like it's well positioned, and I would favor it more strongly just because of this last earnings release. But beyond that, it would just be like that's just a straight guess. And then if we look year over year, like it had a really big beat here, but then it still slid off. Actually, it's a really interesting earnings history. Very strange. Yeah, kind of like mixed bag for me. Anything else that we should look at? You guys good otherwise? I mostly just want to make sure everybody's not getting like crushed out there, getting super disenfranchised and things like that. I think there's a lot to do. I think you can be pretty active right now. I think general thoughts though would be to pay pretty close attention to total risk that's out, and the market with the start of the year that it's having. I don't think there's anything wrong with being slightly underutilized right now and kind of playing things more so by ear. I actually think that that's probably a smarter play, because if the market is going to have some sort of blowout smash move to the upside, with the down move that we've seen so far, like you'll literally see it. You'll see it happening. You'll see the total tone and tenor change, and you will see people's general perception about the external environment changing just in terms of tonality. And you'll obviously see it through price and volume. So that's one of the reasons why, I mean, even in the coverage strangles that I have on right now, they're super light. I mean, they're all 20% equity or less, which is about as light as you can go. I think most of them are 50% utilized or less. Let me see. The TQQ's coverage strangle is 63%, SSO's 59%, IBIT's 52%. So, I mean, most of that is in short puts. 22% for SSO of that 59 is shares. 17% of TQQ's is shares. The rest is in cash secured puts. I actually offered more puts today, and it's to take advantage of the down move. And I will almost assuredly have to roll these, but that's okay. The volatility is there. So just keep that in mind as you're monitoring the market. Getting into like really big positions right now, if you have a really long-term horizon, it can look very good. I'll go back and say again for the record, like for NVIDIA, I love NVIDIA all in here, but that's for a much longer term idea. I think if you're trying to trade things shorter term, it literally, as crazy as it is to say, it doesn't make sense right now. But if you're trying to build a longer term coverage strangle, long equity position, I mean, you're probably not going to get a ton of good looks at NVIDIA like this over the next 5 years. It's just going to be growing way too fast based on the involvement in AI and whatnot. Now, that is another key theme to keep in mind, though. The AI theme is really, really dangerous, because if things work well, then AI has an unbelievable amount of potential. If we start to see impediments and stuff like that, you just absolutely cannot rationalize the long-term exposure in it. And it's just because that's such a key market factor right now. And if that starts to fall off, then the broad market really starts to look way more tenuous to me. So it's very, very much predicated on that. So kind of some closing thoughts for you guys. As always, if you need anything, hit me up in the Discord. Be an outlier. I'll see y'all later.